A lot of people have been using our equity loans for home improvement projects to turn their basements into a rentable unit so that they can make some extra income.
In terms of a home equity loan, so for our viewers who don't exactly know what that is, or this is a novel concept, how exactly does it work?
So if you've had a chance to look at our website, alpinecredits.ca, there's actually a very cool graphic on there. It says, your property value minus outstanding mortgages equals your equity. And that's what we lend against. It's your equity and up to, say, 90% of the equity in a lot of cases. So what we look at is what is the current fair market value of your property? What are the outstanding mortgages, whether it's a first mortgage, second mortgage, a HELOC product secured against the mortgage, minus that gives you what's available as a cashable asset to you in your property. And from that value, we lend anywhere up to 90% of that to homeowners.
Okay, amazing. And you mentioned this, Gal, earlier, tuition being an example of what people are using such loans for. What are you seeing, these days? And in particular, I guess, what are borrowers typically using these loans for?
Knowing how the real estate market is, a lot of people are taking out equity from their first residential homes to buy investment properties and invest into their kids' future. Because let's face it, with the way real estate market, especially in urban centers in BC and Ontario, is increasing so rapidly, unless we leave something for our children, the concept of home ownership is going to start to become a dream for them. So a lot of families will take out equity out of their home and they put it towards a down payment for investment property for their children. A lot of people have been using our equity loans for home improvement projects to turn their basements into a rentable unit so that they can make some extra income. Tuition is a big one for, secondary, post-secondary education for children. So there's a whole bunch of different varieties that people use the equity in their home for. And like I said, it's really at the discretion of the client or the needs of the client that determines what that purpose is.
Okay, excellent. And Gal, you mentioned the more, let's say, restrictive or onerous requirements by traditional banks in terms of qualifying for loans. So, what are the qualification requirements for Alpine Credits?
Be a homeowner in one of the three provinces, British Columbia, Ontario, and Alberta, and have equity in your property. That's all the qualifications that we look at. Like I said, we don't look at credit. We don't judge people based on their credit. We don't look at employment or employment tenure. And we definitely don't make our clients jump through the hoops that, your traditional banks and credit unions do. We simply focus on the equity that you have available in the property. If it's justifiable and if we can reasonably say that, yes, the market value of this property is X and you have that much outstanding, so you have this much cashable asset available in your property, then chances are we'll be able to do something.
Okay, amazing. In terms of some of these words, these types of loans that we hear, I know that perhaps a financial literacy lesson for our viewers. What is the difference? If we're talking about home equity loans, what's the difference between a home equity loan and a home equity line of credit? If you could spell that out for our viewers.
Yeah, for sure. So a home equity line of credit, it's registered like a mortgage on title of a property. It is a line of credit that is taken out on a property and you basically pay it as you use it. So for example, if you were approved for a $50,000 line of credit on your property, you would use it as needed. Whereas with us, it's mortgage that, yes, it is secured against the property, but it's a one-time shot. So you take it, you get the cash, you borrow based on your current needs. So, 6 months down the road or a year down the road, if you're tempted to spend where it's not really necessary,
Mhm.
you still have to go through the whole process of getting reapproved and having your property reappraised. So it's a bit harder to spend on it than a HELOC product.
Okay, no, that's fantastic. I think, financial literacy is very key and it's good for borrowers to assess a lot of these products, but and be fully cognizant and aware of what they are. So I appreciate you explaining that difference, Gal.